What's up, everybody? My name is Ryan Pulis. I'm the managing member of the Pulis Group. We're a tax and accounting firm specializing in tax planning for real estate investors and small business owners. Today, I'm going to talk to you about business entity choices and how they may impact your taxes. On this slide, we see a list of the more common business entity choices out there. There's sole proprietorship, partnerships, C corporations, S corporations, which is technically a tax election, not an entity type, and the C corporations and an LLC. So the first four on this list, each are treated differently for tax purposes. Each has its own unique advantages and disadvantages. Limited liability companies are a state level entity, but are not recognized by the IRS as having any special taxation. So the IRS will tax an LLC as one of the first four types depending on what you tell them. So by default, single member LLCs are taxed as sole proprietors and multi-member LLCs are taxed as partnerships. Either can make an election to be taxed as an S corporation or a C corporation. You simply fill out the appropriate form and send it to the IRS. So let's take a look at each of these entity types and some of the pros and cons when it comes to taxes. So first, we have the sole proprietor. This is an unincorporated business operated by a single person. So income from a sole proprietor is taxed on Schedule C of your personal tax return. This is true for most operating businesses. If you own rental real estate in your own name, then that is taxed on Schedule E of your personal return. And with a sole proprietorship, you pay ordinary income and self-employment taxes on the business profits. So just one thing to note, rental real estate is not subject to self-employment tax. It's exempt under Internal Revenue Code section 1402A1. So that's not going to apply in the case of a rental property. There's not going to be any self-employment taxes to worry about there. As previously mentioned, the IRS will tax a single member LLC as a sole proprietor unless an election is made to treat it differently, such as a C corporation or S corporation. So the main benefit to using a sole proprietorship is it's easy and cheap to set up. It's going to be the easiest and least expensive entity to set up and start doing business. Now the cons, the downsides to a sole proprietor are there's no asset protection. There's also, as I mentioned, all your income is subject to self-employment tax, and again, unless you are dealing with rental real estate. They're not the most tax efficient vehicle either. Sole proprietorships, your basic Schedule C, there are certain tax strategies you can use, but they aren't necessarily the best, primarily because you're paying self-employment tax on everything. So now let's take a look at partnerships. A partnership is an unincorporated business operated by more than one person. Income is reported on IRS Form 1065 and passes through to the owners or partners on a K-1. So income from the K-1 is picked up on the individual tax returns. Again, you're going to pay ordinary and self-employment taxes on your share of business profits. For example, if you're a 50% owner, you'll be taxed on 50% of the profits. Again, if we're dealing with rental real estate, self-employment taxes aren't going to apply, but otherwise, active partners in a partnership will be taxed ordinary income and for self-employment taxes on their share of the profits. A multi-member LLC is by default taxed as a partnership. If you make an election to be taxed as a C or S corporation, then you can be taxed. Otherwise, that multi-member LLC will be taxed based on the election it makes. Otherwise, it's by default a partnership. Now, some pros to the partnership structure. It's easy to set up. And partnerships are very flexible. It's one of the most flexible vehicles out there. You can also have an unlimited number of partners. There's no restrictions on that. So with an S corp, as we'll see, there's some restrictions there on how many shareholders you may have. Now, some of the downsides or cons to the partnership are no asset protection for general partners. However, using an LLC can fix this. The LLC is designed to provide some level of asset protection. All income is subject to self-employment taxes as we previously mentioned. That's another downside for those active partners. And partnerships come with complex tax rules. It's far more complex than an individual tax return. So that's another downside to the partnership. Now, because income is passed through to the owners, partnerships are often referred to as pass-through entities. This is true also for S corporations. So we'll take a look at S corporations next. S corporation is considered a pass-through entity, as we mentioned, similar to a partnership. It's basically a hybrid of a partnership and a C corporation. So an S corporation elects to pass items of income, deductions, gains, losses, and credits through to the shareholders for tax purposes. An S corporation is a tax election rather than an actual entity type. So typically it's an LLC or a C corporation will make an election to be taxed as an S corporation. Income is reported on IRS Form 1120-S and passes through to the owners or shareholders on a K-1. So income on the K-1 is picked up on the shareholder's personal tax return. Owners of the S corporation business that are active in the business must be paid a reasonable salary, so they'll also receive a W-2. So income is going to come from two places with an S corporation: the W-2 salary for the work you're performing, and then the net income that comes through on a K-1. So as we previously mentioned, single-member LLCs or multi-member LLCs may elect to be taxed as an S corporation, and a C corporation can make an election to be taxed as an S corporation. Some pros of the S corporation are it does provide some asset protection. This is typically through the underlying LLC or corporation that's made the election. Second, the S corporation limits self-employment taxes. So this is the key benefit to an S corporation and the reason most people choose to go with an S corporation. Only the W-2 income is subject to the self-employment taxes, which is why there's a reasonable salary requirement. The IRS wants you to pay something into those self-employment taxes, so you do have to pay yourself a reasonable salary. But let's say, for example, your S corporation produces $100,000 of profits every year. Well, you're going to pay yourself, if we decide a reasonable salary is $50,000, $50,000 of that $100,000 is going to be paid as a salary on a W-2. And the remaining $50,000 is going to be taken in the form of distributions. It's going to be passed through on the K-1, and it's not subject to the self-employment taxes. You're going to pay ordinary taxes on the K-1 income, but not self-employment taxes. And as a self-employed individual or as a business owner, you're subject to both the employer and employee side of self-employment taxes. So in total, that's 15.3%. 15.3% on $50,000. That comes out to be just over $7,500 in tax savings by using the S corporation with profits of $100,000. Now, obviously, the tax savings are going to vary depending on your required reasonable salary and how much income you're making, but this just gives us a good example of some potential tax savings that are out there. So on to our next pro is with the S corporation is one level of taxation. It's all at the owner level, unlike when you have a C corporation, which we'll look at next. Now, some downsides to the S corporation is, again, it comes with complex tax rules, it files its own tax return, and the rules are more complex than the individual tax rules. Second, we have limited number of owners. You're limited to 100 shareholders with an S corporation. So these companies tend to be smaller. If you are looking to put in place or build a very large company, an S corporation may not be the best entity structure for you. And there's not a lot of flexibility with S corporations. It's very easy to lose your S status if you do something wrong, for example, by paying out unequal distributions to shareholders. That's where the partnership is far more flexible. But let's take a look now at our C corporations. So a C corporation is treated as a separate tax-paying entity, completely separate from its owners. Income is reported on Form 1120. The owners are generally paid a salary and may also receive dividends. So corporations are best for businesses that want to reinvest their profits. And we'll discuss why shortly in a moment. It's not a good entity to hold real estate. Holding real estate in a C corporation is a bad idea. It's difficult to get it out without triggering taxes. So typically you want to keep your real estate in an LLC. Some pros of the corporation are the asset protection. Typically you're going to get the best asset protection with a C corporation. Now just let me mention, I'm not a lawyer. I don't specialize in asset protection. This is my understanding and based on what I've seen over the years doing the accounting work. Other pros with the corporation are fringe benefits are available for shareholders. They're treated just like other employees, where when you have a partnership or S corporation entity structure, fringe benefits are limited for shareholders and partners. Corporations are subject to a flat 21% tax rate. So if you're keeping profits in the business and reinvesting them and not pulling it out where you become subject to double taxation, that flat 21% rate can really play to your favor, especially if you're a high income earner. The high rates on individuals is 37%, where the corporation is 21%. Some of the cons of the corporation are, again, separate tax return, complex tax rules, and then the big one is double taxation. So with double taxation, so the corporation itself, as we just mentioned, is subject to a flat 21% tax on its profits. If the owners pull money out that's not taken out as a salary, subject to your ordinary income tax rates, they're going to take out money as a dividend, and that's going to be taxed again. So dividends are not a tax deduction. So you're going to pay 21% on corporate profits for the corporation. Any dividends are paid out after tax. So then those owners pick them up on their personal tax return and are going to pay taxes at the dividend and capital gains rates, which could be 0, 15, or 20% depending on your income level. The 0% rate applies when your income's under $45,000 for single filers or about $90,000 married. Then it goes up to 15%, and it stays at 15% and will bump up to 20% when income's about $500,000 for single filers and around $550,000 married. So that's something you need to pay attention to if you're set up as a corporation and need to take money out. Now, there are strategies to work around that, but in general, those are the rules. Now, our last entity type is the limited liability company. So limited liability, or LLC, is a business structure created by state statute. As we previously mentioned, single member LLCs are by default taxed as sole proprietors, unless an election is made to be taxed as an S or C corporation. And multi-member LLCs are by default taxed as a partnership, again, unless an election is made to be taxed as an S or C corporation. Setting up an LLC is not a tax strategy. I'm going to say that one more time. Setting up an LLC is not a tax strategy. Simply having the LLC offers no tax advantages whatsoever. LLCs are used primarily for asset protection, hence the name limited liability company. And simply having an LLC doesn't guarantee that protection either, because it needs to be run like a business. You need a separate bank account, separate books. If you use an LLC, it potentially can provide great asset protection if you're doing everything right. But if you don't, if you're not treating it like a business, a decent attorney is going to get pierced through that LLC veil and can likely get to your personal assets. An LLC is taxed as one of the other entities we've already covered, the sole proprietor, partnership, S corporation, or C corporation. It's not its own tax entity. I want to reiterate that because I run into this quite often, that some folks seem to believe that LLCs are a separate type of tax vehicle or entity, and they are not. So, one last slide I wanted to include in here, since we're talking about business entities, is the Corporate Transparency Act. So this impacts most small business owners, anyone that owns an entity pretty much. So I'm going to say, if you're watching this, there's a good chance you have an LLC or a corporation or S corporation. If so, you're going to want to pay attention to this. Even if you aren't necessarily doing business yet, this is likely going to apply to you. So the Corporate Transparency Act passed in 2021 and final regulations were released in late 2022. There's now a reporting requirement to FinCEN, that's Treasury's Financial Crimes Enforcement Network, for all beneficial owners of business entities, including single-member LLCs. So a beneficial owner is someone that owns 25% or more, and this also includes individuals that exercise control over the entity, such as corporate officers, even if they don't have an ownership percentage. This act is effective January 1st, 2024, and requires the beneficial owners to report personal information to FinCEN each year. And that's full legal name, address, date of birth, and a copy of some sort of identification like a passport or driver's license. This is going to impact most small businesses. There are several exemptions out there, but they're primarily for large enterprises that they're exempt from this reporting. Large enterprises are businesses with $5 million or more in gross receipts and 20 or more full-time employees. And then other financial institutions are exempt. And many of these exemptions come into play, I suspect, because these entities, the larger businesses, are already, or highly regulated industries, they're already subject to additional oversight. So the primary purpose behind this, we're told, is to help crack down on financial crimes. However, I'm not a fan of a government list of everyone's identity. However, what I feel has no bearing on the reporting requirements under this act. So you need to be aware, because the penalties for not filing are severe. Penalties for non-compliance start at $500 a day up to $10,000 per entity, and or 2 years in prison. It's probably unlikely if it's just a mistake, but the financial penalties are bad enough on their own. So as I mentioned, this all becomes effective January 1st, 2024. Existing entities just prior, so as of 12/31/2023, have 1 year to comply. New entities formed after January 1st, 2024 have to file within 30 days. And then all entities must update for changes like new address within 30 days of the change. So this is quite a new change, or quite a new filing requirement for many business owners. I wanted to bring it up and mention it. So if you do have business entities out there, you know you have this filing requirement and don't miss it and become subject to the penalties. So that about does it for today. Just to kind of recap in closing, your choice of business entity can have a significant impact on your taxes, so be sure to consider your choices carefully and work with professionals. I hope this video was helpful. Feel free to comment below and hit the like and subscribe button. We are taking on new clients and we'll review your prior year tax returns for planning opportunities. If you'd like to work with us, then hit us up on our webpage at thepulisgroup.com/contact. That's ThePulicegroup.com/contact. Thank you and have a great day.